There are two age-old questions that Indians have always debated. The first one is, should you buy a house or should you invest in equity? I wanted to spin it a little bit. And the second question, by the way, is should you buy gold as jewelry or should you buy a digital form of gold? The spin that I'm adding is, should you buy real estate as a house? Should you buy a REIT, which is a real estate investment trust? Or should you buy a real estate company, that is a listed company that makes homes and other forms of real estate? And the second question that I want to twist is, should you buy jewelry or should you buy a gold ETF or should you buy a jewelry company, something like a Titan or any other company for that matter? And to talk about this in more detail, I'm joined by Vishal Dhawan, who is the founder and chief executive officer of Plan Ahead Wealth, as well as Santosh Joseph, who is the founder of Germinate Investor Services. Gentlemen, thanks so much for taking the time. Vishal, I'll start with the first question, and it's a slightly long question. What are the pros and cons in the first case when we're talking about real estate as a house versus a stock versus REITs?
So I think fundamentally they are very different forms of investing, even though they ultimately give you exposure to an underlying asset class which is the same, which is real estate. So let's take them one by one. If you look at physical real estate, typically you'll find that the advantage of doing physical real estate is that it feels very close to you because you actually own it. You can walk into it, you can rent it out. You have a lot of control in terms of what you can do with that asset. But in order to get that control, you could end up having fairly significant costs associated with buying it on one side. Those could be stamp duties, typically 4 to 7% of the value of the asset. You could have registration costs, very often about 1% of that cost. And then there could be other costs all coming together, which could mean that your cost of ownership increase between what is stated versus what you actually end up paying could be in the region of about 10%. So, a lot of what you see on the price needs to be inflated to that extent to get you the true price. And if you add a loan on top of that, that cost goes even higher. The other thing around real estate is that physical real estate is that liquidity in that asset can be fairly challenging, especially when you go through a bit of a downturn. And we've seen multiple cases where it can take months or even years to be able to liquidate that asset if required. And last but not the least, if you need to manage it because you choose to rent it out, there could be a lot of work that you need to do from identifying a tenant to ensuring that the property upkeep is maintained. You have maintenance costs which come in, etc. So one needs to keep in mind that while the comfort of owning it is very high, there are additional things which go along with it. Now, in contrast, if you look at real estate stocks, for example, they give you access to specific real estate companies. And those real estate companies, in turn, may be either diversified in terms of having access to multiple geographies, or they may be in a specific geography. And a lot of how they will perform will partly be driven by the change in property prices, but also be driven by the balance sheet of that particular developer and the macroeconomic cycle and everything else that particular individual company is exposed to. And therefore, for example, if you end up having a broad-based stock market correction, you could end up finding that even though real estate prices are not corrected, the real estate stocks end up correcting in the process. When you come to a REIT, in contrast, the REIT is normally not buying residential real estate. The listed REITs in India are either buying commercial real estate or they are buying retail spaces or renting out retail spaces as a result. And therefore, for you, your income there is largely going to come in the form of a rental yield, which could take the form of a dividend, or it could come to you in the form of capital appreciation. Now, the advantage here is that you get the access to commercial real estate and the growth in the economy without the headache of managing that space, because the REIT will manage that space for you and just give you a particular rate of return. It's also very convenient because you can sell it on the stock exchange just like you sell a stock. The disadvantage though there is that very often it will not give you that sense of ownership that you want when you buy real estate. And especially if you're looking for residential sort of exposure, then a REIT doesn't really give that to you. It gives it to you in the form of commercial space.
So you've summed up the pros and cons quite well, and I will circle back to you after I hear what Santosh has to say, whether he agrees with everything that you've just now discussed, or are there any elements that he disagrees with. So that's the first question, Santosh. And would you say at this point, given the kind of shift that you've seen in the tax laws and a lot of people moving to the new tax regime, that incentive to take a home loan in order to buy a property, and a very long home loan at that, and a sizable one, is no longer there, because you don't get the benefit of that interest payment in the form of a deduction?
So, Alex, hi. Vishal really explained it very well. So, there's nothing to disagree. I agree with almost everything. The way he broke it down, I think he did a great job. But I think I'll just step back and say there are two reasons that we have to consider. Now, if there is a need or if there is a want. Now, for many of us, when we actually need a home, the pros and the cons actually don't need to come up, because you just need a home, you need for your family, you need for you to stay in. But when it comes to investment, all the stuff that Vishal explained becomes very important and material facts to make the decision. The second important decision that for many people this swings the deal is the difference between the emotional benefit of owning physical real estate versus the rational benefit of actually buying stock or REIT to get the benefit of real estate without actually physically it. Now, the third part that you're talking about, does it make sense today when the new tax regime is not so beneficial towards the interest that you pay towards home loan, because that's also an additional cost to the home. So I think Vishal again explained it. The home loan, the home cost that you are, told about, or the list price that is there, you have to add duty, you have to add interiors, you have to add other expenses that to make the home livable. On top of that, you also had to add another layer of interest costs that actually add up to the total cost of ownership. Now, when you look at the total cost of ownership, if it's for an investment, you're unnecessarily increasing your own cost to buy something only for an investment return. Therefore, with interest rates, with tax benefit, and the total cost of ownership going up, it is better today, if you're looking from an investment perspective or diversification perspective, to buy it either in the form of equity or in REITs, depending on what suits you best in terms of exposure to real estate.
Vishal, you want to drive home that point for us, because a lot of people say, hey, you know what, I bought a house for 1 crore, it is worth 1.5 now, and I've made 50% gains. But effectively, they'll be talking about it even while they're paying an EMI, and they're not accounting for the cost that they're paying, and the overall cost that they're paying, for example, for a flat screen television that they've set up, or the furniture that they've spent a couple of lakhs on. So how do you drive home that point when you say, are you really looking for an investment return? And here I'm assuming that you're talking about buying a home as an investment, Vishal, and not as something that you would live in.
Absolutely. So I think it is quite common, just like we miss out those stamp duties and registrations and all of that, we also tend to miss out the cost of the loan. And that cost of the loan over long periods of time can be very significant. And as virtually everyone would be aware, in an EMI model for a home loan, the initial period is where you end up paying a lot more interest. And towards the latter part, you end up paying more principal. So what ends up happening for you is that when you start to look at your overall cost, you could end up finding it's significantly higher than what you imagined it to be. Of course, leverage works very well if an asset moves up substantially, because let's say if you look at home loans today, home loan costs, because of the rate cuts by RBI, are now in the 8% and below range very often. And if you get returns which are substantially higher than 8% on the real estate, then you could say the leverage is actually working in your favor. But that doesn't happen all the time. The other thing that you need to keep in mind is that, very often the tax breaks on that end up becoming the talking point, especially when you rent out, because you can actually claim the interest as a deduction. And even if you aren't able to rent it out, the budget this year actually made a change whereby it went out and said that if you have 2 self-occupied properties, those now become assessed to nil value, and therefore you don't have to pay tax on a deemed rent. So to that extent, physical real estate has become a little bit more attractive as compared to what it may have been, a few months ago before this change happened. But in any case, the total cost of ownership, which both you and Santosh alluded to, is ultimately what determines what's going to be a rate of return. Because otherwise, it's just giving a wrong outcome. And therefore, even a simple mathematical calculation on rate of return won't work here. You'll have to do an IRR to see how your inflows and outflows into the property actually worked to get the total rate of return that you made over a period of time.
So to conclude on this leg of our conversation, gentlemen, I'm going to throw it back to you. So when you're talking about investments, of course, there are certain pockets where real estate and physical real estate becomes extremely attractive, high growth areas, etc., etc. But if we're talking about the metropolitan cities, if you have to shell out a couple of crores, and if it's going to account for a very large portion of your portfolio, I would assume that you would say that either a REIT or a real estate company, even as part of an overarching investment portfolio, might make more sense. Vishal, I don't want to, or Santosh, I don't want to put words in your mouth, so I'm going to toss back to you to say, in the order of hierarchy, how would you rank all three? Vishal first.
So,
yeah.
Okay. So typically, the way we look at it is that the hierarchy in our mind is REITs first, for the fact that they are probably the most predictable in terms of outcome. The second is a diversified portfolio of real estate stocks, because you don't want to be caught with just one of them and find that that particular stock gets caught in some specific company oriented issues, and therefore your exposure doesn't go. And then third, physical real estate.
Santosh, do you concur, or do you have a different order?
I'd go with possibly looking at stocks first, because if you're going to be looking at returns, REITs are stable, but I think stocks have the potential to outdo even REITs, and we have enough data to back that up. So I think I'd go with stocks first. Then for stable and rental income sort of kind of yield, you look at REITs, and then if you have to, beyond what you have, you look at physical real estate as ownership.
You have a very large corpus, for example, or if you want to book capital gains and diversify your portfolio, then perhaps that's something to look at. Now, so that's one leg of the conversation. Gentlemen, do you have any recommendations for, and not recommendation, I should amend myself, any REITs? Santosh, I know that you studied this carefully. So if somebody is going out there and looking at the various REITs, there are more that are coming through. Micro REITs also is something that people have spoken about, not really taken off. So which REITs are good, which REITs are not? Do you have an opinion?
See, by and large, all of them have to give you a same structure in terms of how REITs are structured. And like what Vishal said, REITs largely give you access to, number one, office space, retail space, and at some level, the commercial real estate space. So the payouts are quite stable. We have a history of reasonable payouts. So you have Embassy, you have Mindspace, you have Nexus, and you have more coming up. But these three are already present, and they have a track record. So investors are, comfortable. If they're comfortable, these are the three names to go for.